So welcome. We're starting with a really interesting session. We'll have a first paper by Michael Kumhof, co-authored with Mauricio Salgado-Moreno from Bank of England. They're dealing with quantitative easing and quantitative tightening. The money channel will be discussed by Marco Lombardi, from Bank for International Settlements. After that, we'll have the second paper, which is Acharya from NYU, co-authored with Venky, Venkateswaran, also from NYU, and Sebastian Hillenbrand from Harvard Business School. That'll deal with pandemic-era inflation and interest rate uncertainty in the US. The discussant, Luke Levin, unfortunately could not make it, but stalwart Jurica Zrnc has stepped in and will provide a discussion for that, supplemented, of course, by comments from all of you. So that's the plan for the next hour and a half. And Michael, the floor is yours.
Thank you to the organizers for allowing us to present this work in front of such a distinguished audience. This is joint work with Mauricio Salgado-Moreno, both of us from the Bank of England, and the usual disclaimer is at the bottom of this page. So this is a paper about integrating into a single analytical framework the traditional interest rate tools that central banks have been working with and the much newer balance sheet tools. The data for the most recent period are shown on this page, just as an appetizer. You see there the reserves to GDP ratio in the United States, and we will be focusing on the United States, which starts around 2008 at very close to zero and has recently been closer to 20%, and the average over the sample period is 11.5 over the period that we'll be looking at. On the right, you have the ONRRP and interbank rate, effective federal funds rate in the United States. And if you look at the same point on the horizontal axis, which is September 2019, the liquidity shortage, there were both big movements in the quantity of reserves and also in the interest rates. And the question that we're asking is, how does this inside the plumbing work in the financial system, and what effects do we expect? So to do that, we built a theoretical model as a lab for balance sheet policies, and we study QE and QT policies. We also study what I would call modern bank runs, which I'll talk about later, and how that transmits to the real economy in an economy with abundant liquidity. So this will be an economy that I never even compare to the situation before 2008, where banks operated with very low reserves, but it is from the start an economy with abundant liquidity in aggregate, but not necessarily in every pocket of the financial system, and that's an important qualifier. So in order to study this, we built a medium-scale dynamic New Keynesian model, the usual real sector, but a more detailed financial sector in order to get at the plumbing. The emphasis is on the liability side of the central bank's balance sheet. A lot of the literature that has been written about QE and then about QT was about the asset side, the interventions in asset markets, the purchases by the central bank of certain assets, and what does that do to asset markets and interest rates, etc. And of course, that's also present in our work, but we focus more on an aspect that has been relatively neglected, which is the liability side and the specific function of reserves in the financial system. And specifically then the transmission of QE and QT policies through the reserve and interbank markets. In our analytical framework, banks face, for realism, the usual frictions or regulatory constraints, capital liquidity, and interbank exposure frictions. And so what I highlighted in red there is critical because it distinguishes us from much of the existing literature, is that reserves are not liquid assets directly held by households, but instead they are banks' settlement asset, because reserves can really only be held by a very small number of financial institutions. I don't need to explain that here, but this is important because if you neglect that aspect, you don't get at what we're getting at in this paper. So a quick preview of results. We look at steady state and dynamic effects of the quantity of reserves. We are adopting a model with ex-ante heterogeneous banks, so there are pockets of banks that have fewer reserves to start with, reserves scarce banks, and then reserve abundant banks. Reserve scarce banks are more severely affected by shocks to liquidity in the interbank market. We find that permanent QT has non-trivial negative, if not huge, but also non-trivial negative effects on real activity. We look at the shape of the ESO market rate curves. It depends on the distribution of reserves inside the financial system and on the interbank market structure. And we look at nonlinear effects on equilibrium interest rates on R star. And then we look at dynamics. We look at net deposit withdrawal shocks, which is another way of describing modern bank runs where depositors of one bank run to another bank. They don't withdraw cash or withdraw anything from the financial system as a whole, but from an individual institution in order to deposit it elsewhere. We also look at asymmetric lending booms, which is focusing on the asset side of banks instead, and then the potential for countercyclical reserve rules to make a difference in the dynamics. And you could think of countercyclical reserve rules as a dynamic QE, i.e. countercyclical QE, whereas in the first part of the paper we focus on steady state effects of QE. So bird's eye view of the model, obviously I can't go into all the details, so it's literally a bird's eye view. We start at the top, bond investors and the central bank, and QE and QT policies are carried out, by and large, between the central bank and bond investors and not between the central bank and the banking system. The banking system only comes into play as an intermediary in this. So basically, the QT means the central bank sells bonds to bond investors, and we will be focusing here on QT rather than QE most of the time. Then we have the central bank that interacts with wholesale banks. The blue areas here are all the banking system, but for analytical purposes, it's split into wholesale banks and retail deposit and retail lending banks. Wholesale banks are composed of two groups of banks that are ex-ante heterogeneous, and that plays an important role. Group one is the reserve abundant group. Group two is the reserve scarce group. The central bank interacts with these banks through the reserves market, and these banks interact with each other also through the reserves market and also through the interbank market. Then we have the household side. The households interact with deposits, deposit banks, retail deposit bank and retail lending banks. This captures something that I've been emphasizing for a long time, which is that banks do not face financing risk, only refinancing risk. In other words, a bank finances every loan by creating a new deposit. So it has no problem financing a new loan because it does that in-house. The problem arises if that deposit then goes away to another bank. But that it cannot go away from the financial system as a whole, only from that bank. But that can nevertheless, of course, cause problems that are not just micro, but also macro. The households face a deposits in advance constraint for purchases of consumption and investment goods. So it's not like a traditional cash in advance, but deposits in advance, which is by and large how modern economies operate, that the banking system's liabilities are used as the medium of exchange for conducting transactions. Bond investors, at the top there, arbitrage a portfolio of government bonds and wholesale deposits. This is important because when QT happens, they pay for the bonds that the central bank sells using wholesale deposits, and then the central bank clears those. We'll talk about that. And then we have money market funds, MMF. They buy wholesale deposits from these two groups of banks, and they're imperfect substitutes to the money market funds, and this is our way of getting at the notion of modern bank runs. It's these money market funds that are going to run from, not from the financial system as a whole, but from one of these banking groups to another of these banking groups. Okay? And the customers of money market funds are retail deposit banks that demand a homogeneous medium of exchange aggregate of deposits. Very briefly on the analytics, the key is really wholesale banks. We have these two groups that have identical steady-state net worth, identical loans, but differ in their deposit base and therefore in their reserve holdings. Right? And both of these groups operate subject to three costs and frictions. One is reserve scarcity cost, which is increasing in the ratio of deposits to reserves, meaning as reserves go to zero, this cost goes to infinity. Then minimum capital adequacy rule. These costs are increasing in the ratio of loans to net worth. The banks cannot expand their balance sheet willy-nilly. There's a cost. Large exposure limit cost, which applies only to the banks that lend into the interbank market, and that is increasing in the ratio of interbank loans to net worth. And the balance sheet of the two banking groups are shown at the bottom of this page. L is loans, M is reserves, O is interbank loans, D is deposits, and N is net worth. And you see that bank group 1 has O on the asset side. It lends into the interbank market, and the other group has it on the liability side. The important thing is that banks optimize over gross positions. I emphasized this earlier. Both households and banks optimize over gross financial positions, not over net flows of savings. And then we have the first order conditions. And I'm showing these in highly stylized forms in order not to show a lot of the gory analytical expressions. But there's some intuition here and also some quantitative information because we calibrate this model to US data over that sample period. And the reserves first order condition says that the interest rate on wholesale deposits, RW, is equal to the interest rate on reserves, R, plus something related to reserve scarcity cost, and that is because reserves don't just pay an interest rate, they also have a convenience yield to banks because they reduce these reserve scarcity costs. And you can find in Wissing-Jurgensen's various stories for what those reserve scarcity costs can represent. Then we have the interbank loans, and that RO is the interbank rate that is higher than the wholesale deposit rate, subject to not just these reserve scarcity costs, but also minimum capital adequacy related costs, and that's because making these loans eats up some capital, and subject to large exposure limit costs, and that is because making these loans is risky up to a point. And the spread there is 22 basis points in the data, 22 basis points for interbank loans and 12 for wholesale deposits. And then household loans, similar to interbank loans, but the spread there is higher, and this is because specifically the minimum capital adequacy imposes higher costs when you lend to non-banks than when you lend to banks. Households, I'm trying to be very brief with the analytical foundations and get to the result. The households choose consumption hours, investment capital, loans, and retail deposits to maximize lifetime utility, subject to sequences of budget constraints, participation constraint, and this deposit and advance constraint. This is why banks are needed in this economy, because the households can only conduct transactions in consumption and investment, and when households invest here because households and manufacturers are lumped into one, right? And so they can only invest or consume if they have enough deposits on hand. So if the banks contract lending or make lending more expensive, thereby creating fewer deposits, this can affect the real economy. The flow budget constraints of households is basically in very stylized form. Deposits minus loans is equal to interest on deposits minus interest on loans, plus income minus spending. Income and spending are real terms. Income minus spending is saving. All the other terms are financial. And what this budget constraint shows that if households want to acquire additional deposits in order to engage in additional economic activity, purchase more consumption or investment goods, all they need to do is get more loans, expand. The banks need to expand their balance sheet. This is all subject to a cost, and there'll be a price that makes it right. But it is about financial magnitudes, not about real magnitudes. Income and spending actually has nothing to do with it. If a company receives a check from another company and deposits it in the bank, that doesn't increase the quantity of deposits, because unless the the first company wrote a bad check, that check only has value because the deposit already existed somewhere else in the financial system, and the second company that gets paid just redeposits it, and the identity of the depositor changes, but not the quantity of deposits. Okay, central bank and government, this closes the model block. The central bank pursues a conventional interest rate rule with forward-looking inflation, but it also supplies reserves. MRAT is the ratio of reserves to GDP, and we assume that it follows a potentially counter-cyclical reserve rule that varies the ratio of reserves to GDP in response to changes in the spread between the interbank rate and the policy rate, the ONRRP in this case. This feedback can be set to 0, but it can also be made countercyclical. And the central bank balance sheet is very simple. Reserves are backed by the portion of government bonds that are held by the central bank, and the rest is held by bond investors. Only one slide on calibration, namely the aspect that's interesting to this paper. We match the empirically observed demand functions for reserves and interbank loans as best we can. What we see here on the horizontal axis is the reserves to GDP ratio. On the vertical axis is, on the left, the spread between the federal funds rate and ONRRP, and on the right between LIBOR and ONRRP. Remember, sample ends in 2019. These circles are individual data points over that sample period, and the blue line tries to sort of approximate this set of points. And basically, it's not linear. That's important. As reserves go towards the left, more and more QT, 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 these spreads will go up non-linearly. So QT, first of all, the transmission mechanism. So I have here the central bank, bond investors, and on the right you have wholesale banks. What is QT? The central bank sells bond to bond investors. Banks at that point have nothing to do with it. Basically, the central bank therefore exchanges bonds against deposits, and now has deposits, wholesale deposits on its balance sheet, but then it clears them, right? It clears these deposits against reserves, and at that point, reserves and deposits in the wholesale banking sector decline. They are drained from the system. And that's also what's happening in our model. And what this now shows, and I'm going to zoom in on various different aspects of this over time, is on the horizontal axis is, again, the reserves to GDP ratio, and this is the steady state of the model in every case. This is not about countercyclical policy yet. And so at 11.5, you have a vertical line every time. That's the steady state reserves to GDP ratio in the US over our sample period on average. And as you go to the left, you do QT. You sell bonds into the market, reduce the quantity of reserves. And we have calibrated the model on the top left such that B1 banks start with 9.5% worth of 9.5% of GDP worth of reserves, and the other bank group with only 2%. So it's asymmetrically distributed reserves. And that means when you do QT, that bank group gets into hot water more quickly. Next point relates to R star, the real interest rate on reserves, and what it has to be in equilibrium to clear the market. Okay, so there are two effects here. As you go from high reserves to the left, low reserves, QT. One is what the IMF now calls the Laubach effect in its debt sustainability analysis, which is that when there is a higher bond free float that the market has to absorb, then the interest rate that has to be paid on that is higher. And that's what you see on the right-hand side of real reserve rate. It goes up as more and more reserves are reduced and the free float increases. And if that was the only effect, this would keep going up as we go to the left. But there's another effect, which we call the liquidity effect, where lower reserves mean a lower rate. And that is because of the convenience yield of reserves when reserves get really scarce. When the banks are willing to live with a very low interest rate on reserves, just so that they can have what is left of the reserves, because otherwise they feel like they would be in trouble. Okay, and that's why we get a hump-shaped profile of the real reserve rate. Next aspect is the interbank market. As we go to the left, as I said, the reserve scarce banks lose some of their reserves and get into hotter water than before. Now, what that means is that they're going to try and borrow some of it back from the other bank groups, the reserve abundant banks. So the interbank rate spread as a result goes up, and the interbank loans go up. okay? That's the interbank market. Now, with QT, the banks then have to compete for, I'm only going to focus on what's on the right here. With QT, the banks have to compete for the remaining deposits that are in the market. The stock of deposit declines, as we saw at the beginning when the central bank conducts QT, the stock of wholesale deposits. And the banks now compete for the remaining deposits by paying higher rates. But the reserve-scarce banks have to compete especially vigorously, meaning they have to pay an extra high rate, and that imposes a cost. You see that at the bottom. Their spread goes up from 22 basis points to something like almost 80 basis points as the reserve stock approaches something in the neighborhood of 5% of steady-state GDP. And then real activity, QT leads to a moderate decline in GDP. It's not huge, but it's also not negligible. And that is because of the greater cost of money creation, liquidity creation for the financial system, especially by the banks that are now forced to scramble for liquidity, to raise their interest rates. Their business model is suffering, and therefore they can do less for the real economy by creating liquidity. You see the effect on GDP is not large, but it's about 0.4% in our numerical example here, for about a halving of the stock of reserves relative to GDP in steady state. Next thing I want to turn to is how we can use this framework to think about the ISO market rate curve of Wissing-Jurgensen. So quick reminder, what that curve shows you is the schedule with all possible combinations of the reserve supply and the interest rate on reserves, which achieves the same interbank rate target. So basically, there can be the same policy stance with different combinations of those two monetary tools that I started out with saying, you know, they're both in the model. This is what our paper is about those two tools. Here they're both in the, they're both combined in order to achieve the same interbank rate target. And here is where we're trying to look at that, where the middle row is our model, the simulation that we've just spent 5 minutes going over. These are, again, steady states. And there you see that the real interbank rate, which is, the real interbank rate is not flat, whereas the ISO market rate curve is about what does it take to make that flat, okay? Formally, what you need to do in an analytical model like that, if you want to say this rate is no longer endogenous, but we exogenize it, then we have to drop one equation. And that drives home the intuition is that you have to make a decision when you want to say, how do I fix the interbank rate? Is this a demand or supply-driven interbank market? So the equation that we can drop is either the demand or supply curve for reserves. When you have a demand-driven interbank market, then the lenders are no longer looking at their credit risk premium when lending to the banks that need to borrow. When we're looking at the supply-driven interbank market, the borrowers are no longer looking at their first-order condition. So in a demand-driven interbank market, observe now that the real interbank rate is now flat, right? In the top row. And so now we're saying, what does it take? Well, in a demand-driven interbank market, the loan supply first-order condition is turned off, and that means that the lending banks are very relaxed about credit risk, and therefore the interbank loans expand a lot with not a very high increase in the interbank lending rate, and that leads to an ISO market rate curve that is hump-shaped, but it's not very hump-shaped, and there is not a big liquidity discount at the left end of the spectrum where the reserves become really small. So that would be a demand-driven interbank market. When you have a supply-driven interbank market, it looks different, and in the interest of time, let me just say, in that case, the curve becomes much more hump-shaped, and the convenience yield is high, and the ISO market rate curve shows a very low interest rate for low reserves. Now, Net deposit withdrawals. This is our notion of modern bank runs. So this is the first part of the dynamic part of the model, tracing the dynamic effects in this market. So here we have money market funds in the middle and the two wholesale banks on the left and the right, and the wholesale banks on the right are reserve scarce ones. And we're assuming, and think of this as Silicon Valley Bank, that the money market funds are now withdrawing funds from that bank, writing a check, depositing that check in Citibank, which is in B1, in the B1 group of banks. And of course, that check is going to be cleared using reserves, meaning Citibank is going to gain the reserves and Silicon Valley Bank is going to lose the reserves. And it started off with not that many reserves to start with, okay? These are the dynamic responses to a shock like that. That red arrow there points at what the shock itself is. Green is Citibank and red is Silicon Valley Bank. Citibank gains a lot of deposits. The deposits run from Silicon Valley Bank. I mean, Silicon Valley Bank is, in the model, it's really two equally sized group of banks, but it helps to think about it this way. For Citibank, their rates that they have to pay on their deposits is almost unaffected. But for the other banks that have lost reserves when they already had few, they now have to compete vigorously for the remaining ones, have to raise all their interest rate on the deposit side and therefore also on the lending side. They have to borrow in the interbank market. If you look at that blue box at the bottom, they borrow back a lot of the reserves that they lose from the other bank, as long as the other bank is willing to lend, which it is, but only at a premium because this is risky, then it borrows back some of those reserves. And as a result of this shock, you get a drop in GDP of over 0.5 percentage point and a drop in inflation. This imposes real costs in the economy because one part of the banking system no longer works very well because it has to pay much higher rates in order to create its liquidity. Countercyclical reserve rules provide welfare gains. So this is the same simulation that we've just seen. In that simulation, the quantity of reserves that the central bank offers was fixed. Now we're saying, let's have countercyclical QE, where when a shock like this happens and people run from one pocket of the banking system to another, the central bank observes that the interbank spread increases. And when it observes that, that's the signal to inject more reserves into the market overall. And you can see with increasing countercyclicality, ending with the dotted line, you can see that all the effects of this shock are dampened and ultimately halved. So a central bank policy that prevents shortages of reserves during distress can have significant real economic benefits on a countercyclical basis. Asymmetric lending boom. In the interest of time, because I need to conclude soon, I'm only going to talk about this quite briefly. The important thing to notice is when people often object when I present models where banks create deposits by making a loan and then they say, yeah, but that deposit is then going to go away to another bank, so you can't just do this willy-nilly. Yes, but when all banks expand credit in lockstep, this doesn't matter. Because, and you can see, you can look at the data for the interbank market, it doesn't matter because it will tend to gain back as many deposits as it loses. There's a little difference at the end of the day that is cleared through the market for reserves. However, what we show in the paper, and I have to refer you to the paper, is when the lending boom is asymmetric, i.e. when one part of the banking system expands and the other one doesn't, then, because depositors have preferences for deposits that are more or less in fixed proportion or in not so much varying proportions, then for some of the loans that this banking group creates, it will lose the deposits, and that will actually dampen the effects of its expansion. Nevertheless, when one bank doesn't do anything and the other one expands lending, this overall creates more liquidity, and this will tend to be expansionary, which is what this shows. Finally, welfare. This is still preliminary. We're working on this almost as we speak. This is a surface of welfare, meaning consumption gains relative to a baseline. as I change the coefficients of the rules. And as I go to the northeast here, I change the inflation coefficient in the Taylor rule. This is a standard story. And that stabilizes the economy better, and therefore I get welfare gains. Nothing new here. If I go in the northwesterly direction, I change the countercyclical coefficient on the reserves rule. So as long as these interbank withdrawal shocks are important empirically, which is what's underlying this as an assumption, then this rule also has a very significant countercyclical effect and can complement what the monetary policy does. So a conclusion, we built a model to try and understand what the transmission is of QE and QT, both in steady state and in a countercyclical sense, in a stabilization sense. And we, in order to do so, we embedded that model with a full financial sector with a role for reserves, where and the reserves are used for settlement among banks. They are not used for payment among households. They're not just another short-term bond, because they're not. They can only, in the UK, they can be held by approximately 200 financial institutions, not by you and I. Now, the model results, then I'm done. A sizable QT increases interbank spreads and lending rates and reduces output moderately, but not massively, but also you can't neglect it. Of course, for that, we need to know the precise shape of the demand curve for reserves, and that's an ongoing research question among many central banks. The equilibrium policy rates are lower with QT because of the liquidity discount. That's the hump-shaped profile of R star. Deposit withdrawal shocks or modern bank runs have highly asymmetric effects and cause reserve-scarce banks to contract lending, thereby affecting the economy negatively. An asymmetric lending rate shock has smaller effects as banks tend to keep most of their deposits. And finally, countercyclical reserve injections, countercyclical QE, can have sizable welfare benefits. And that's it. Thank you very much.
Thank you. Thank you very much, Michael. And Marco, if you can offer us some comments. Thank you.
Yeah, so thanks very much for inviting me to this great event and for giving me the chance of sharing my thoughts on this very thought-provoking paper. And let me start with a double disclaimer. So on top of the usual one, the second disclaimer is that I'm no monetary theorist. So I'm going to provide not a traditional academic discussion on the workings of the model, but rather I'll walk you through how I read the paper and how I try to rationalize all this thought-provoking implications and conclusions. Okay, so let me start by summarizing what I learned from reading it and what challenged my prior understanding of the plumbing of the financial system. So the first point that I would like to highlight is that of the difference between financing and refinancing risks in the banking sector. And I think this is what underpins the necessity for central banks to do these liquidity injections, right? So this is about the banks not facing problems in financing their loans, but rather risks of deposit flights that need to be tackled by central bank interventions. The second challenging conclusion or implication of the model, if you want, is that contrary to what I thought, I typically interpreted QE and QT as an asset side phenomenon. If you see the thing from the liability side, then you come up with this ambiguous effect on the interest rate that comes from the fact that while QT increases the term premium, at the same time it reduces the liquidity discount, or if you want, the convenience of reserves. And as such, the real effects of QT go mainly through the channel of these higher refinancing costs for the banks. Third important point, that of modern bank runs as runs on the deposit that shift from one institution to the other rather than from deposit to cash. And this underscores the importance of the distribution of the reserves within the banking system and not just the aggregate amount of reserves available. And then finally, the other important point that challenged my view that if you want, balance sheet policies are a way of providing monetary accommodation at a zero lower bound. Here, reserve interventions, and that is QE and QT, and conventional monetary policy, they actually serve different purposes, to the point that you have a different policy rule in the model that deals specifically with the provision of reserves. So these are the key takeaways, and now I'm going to tell you how I try to square them with my prior knowledge I had on money and money demand. So that's the demand for money according to the standard textbook. Here the interest rate that's set by the central bank is the opportunity cost of holding money. And note that with this word money, I mean something that has a settlement purpose and pays no interest. So it's either cash or non-remunerated reserves, as we had prior to the GFC. So in this world, given that the interest rate is opportunity cost, the demand schedule is downward sloped, and reducing the interest rates actually expands the supply of money. Now, in this world of remunerated reserves, it seems that you can read the thing from the opposite side. So here, reserves are remunerated. They're not only a means of settlements, but also serve as a store of value. So in this case, you have an upward sloped demand schedule, pretty much like you have for bonds. And in this case, a reduction in the interest rates reduces the demand for remunerated reserves. So I had this. I put down these two graphs to rationalize the way I see what I found puzzling about the results in the paper. Now. First point I wanted to make, in this setting, monetary financing, as you point in the paper, is not so bad. And the reason I think it is because in here it does not end up as cash that's handed out to agents, but rather it shows up as higher reserves and a marginally higher equilibrium policy rate, as you show in one of the figures. However, this comes with a lower spread with the interbank rate, which reduces the opportunity cost of lending and has even moderately positive effects on real activity. Fiscal shocks you don't show, but I suppose also these will have only an inflationary effects through the Phillips curve channel in the model, and there's no other way that money per se creates inflation. Second point is about the government debt. So according to what I thought I knew, high government debt is not good because you have to pay higher rates due to higher term premium, higher servicing costs, and therefore, in the end, less fiscal space. Well, here, government debt is necessary because it's collateral, and without sufficiently high government debt, central banks cannot run this reserve provision, unless they're okay with private bonds or uncollateralized lending. And here my question is that the demand for government debt by this B2 type of investors that are less deposit rich, is that more or less elastic to the interest rates compared to those of B1? There's an empirical paper by colleagues of mine at the BIS in which they show that more speculative investors, they have more elastic demand. So are they likely to hold more collateral as the QT goes ahead? And so finally, some implications for the operational frameworks. So the underlying assumption in the paper is that we are in an abundant reserve system and we are there to stay. So in that system, as I say, the reserves serve two purposes. It's settlement and investment, or if you want, store of value. And therefore, a central bank should match the demand for reserves, which happens to be time-varying, as shown in this very nice empirical paper by the New York Fed. In a scarce reserve system, reserves are only for settlement purposes. And therefore, the question is whether the demand for reserves may actually be endogenous to the purpose that they have in the system. And therefore, if we were to go back to a scarce reserve system, as Claudio pointed out in a Vox column recently, you may actually face a different and lower demand for reserves. So let me conclude with a couple of political economy counterpoints. All this discussion, including that of the abundant versus scarce reserve system, to me it underpins preferences on the size of the balance sheet and whether we as central bankers are comfortable or not with large balance sheet. In the model, that's no big deal. Actually, in the comparative statics, you even have positive effects of a larger balance sheet. In reality, I think the concern is to making losses on larger balance sheets, which means if we just exclude the issue of negative equity, it means no distribution of profits to the sovereign, which may turn into a threat to independence. And by a similar token, a countercyclical reserve provision, as it's foreseen in the model, that is not an emergency facility, but it's just a standard rule that runs in parallel with the interest rate rule, and which is shown to be optimal in terms of being welfare optimizing. Does that give the risk of being perceived that the central bank constantly bailing out banks and therefore constitute yet another threat to the independence? I know these things are not represented in the model, but I just wanted to put them on the table as food for thought and food for discussion. So this concludes my remarks. Thanks a lot, and thanks.
Thank you. Thank you, Marco. I think we should move right away to the next paper, and we'll save the comments and questions at the end. So, Viral, if you can come and present the second paper, we'll get the presentations first. Yes.
Okay, thank you so much, Paul and Tomislav, for inviting me, and thank you, Governor, for your very interesting remarks. This joint work with Sebastian Hillenbrand at Harvard Business School and Venky Venkateswaran, my colleague in the economics department at Stern. This is a very simple paper, relatively speaking, and it doesn't exist yet. It only exists in this deck form. But hopefully it'll make a simple point, as you will see. It was born out of one observation when I was at the Central Bank of India as a deputy governor, that when we did our models of interest rate calibrations, a team from IMF headed by Douglas Laxton had implemented some models for the Central Bank of India where central bank's own credibility parameter was going to be updated after each action based on whether it actually made a sacrifice in the right direction or not. When I started out, I thought that was a reasonable model for the Central Bank of India. We had just started inflation targeting in 2016. But as time passed by, I've sort of reached the conclusion that no central bank can take its credibility for granted. It's always under the scanner of markets at each instance, and that some learning about the central bank's parameters, perhaps because those at the helm of the central bank keep changing and their views are constantly being learnt about, is always at work. So I'm going to do something like that, where there's a notion of learning about the central bank and whether that can be importantly reflected in some market data that's out there. And I think that's going to be the key innovation over the model that was in place that we had at the central bank in India. And we're going to use the COVID period for the United States because I think most objective observers would agree that perhaps the Federal Reserve's credibility came under some question mark during that period because inflation surged to very high levels. Fed response was quite delayed, I think, as now openly acknowledged, I think, by the Federal Reserve itself. And eventually it had to raise rates very, very sharply, perhaps to actually, in some sense, restore the credibility of the Fed's response function quickly. So, of course, people have written lots of papers analyzing this inflation. There were large supply shocks during this episode. There were large demand shocks as well. And yet, if you just take a narrative view of what happened in the central banking discussions, at the Fed, there was both a new framework, which had this sort of little bit of a backward-looking averaging part, and there was also this belief that perhaps the initial surge of inflation during the pandemic might have been transitory. So we're going to look at some evidence from markets and try and formalize this notion of credibility. And it's going to lead to a very, very simple metric out of market data about the credibility of a central bank. And we have termed this metric as RI VIX. VIX because it's going to be based on volatility estimates from the market, and RI because it's going to be the relative rate to inflation volatility index. Okay, so if I is the interest rate and pi is the inflation, you can think about this ratio as sigma I to sigma pi. So just descriptively, if you track this ratio, inflation uncertainty sigma pi rose in 2021 very substantially, as I'll show you, whereas interest rate uncertainty sigma I initially remained quite subdued, and then it rose sharply with the hiking cycle. So if you think about this metric, the RI VIX was quite low during 2021, but it spiked during 22-23. Why do we need the markets data? Because no one comes and gives you uncertainty metrics otherwise. You can get them from inflation surveys, but we think they might not be as fit for this purpose as market data. But they seem to go in the same direction. And then we build a very simple theory in which essentially you are learning about the policy type of the central bank. Think about that just as its inflation parameter in a Taylor rule. Low credibility is going to mean that the central bank has very low perceived responsiveness to inflation. And so even if sigma pi goes up, sigma I in the market remains low, and RI VIX would decline in that time. Note that we're not taking a very normative stand here. Maybe Fed wanted that kind of forward guidance. It wanted to commit to the market that our credibility is low. We would call it credibility. They might just say, oh, we were saying we will not raise interest rates. But for purposes of this talk, I'm just going to call it credibility. What's interesting, though, is that if you just get shocks, keeping constant the credibility of the central bank, then this metric would actually remain unaffected in this framework. So RI VIX would remain unaffected, and to then know whether it's shocks which are moving around the sigma pi, you would have to look at the inflation volatility on its own. Whereas if you look at the relative volatility, you will know whether it's the central bank's response function that's contributing in part to the volatility as well. So we conclude net-net that markets had basically priced in a very dovish Fed, maybe, as I said, maybe because of its forward guidance. That is what they thought they did want to do at that point. I'm going to interpret that as low credibility, but that with the tightening, there was a very sharp reversal. The shock volatility then came down from 2022 peak, but we observe in data when we do some calibration that the shock volatility remains quite elevated relative to pre-COVID levels, so that both sigma I and sigma pi are now higher because of these shocks out there. But the credibility part is now restored as far as the ratio level is concerned. Okay, so that's it. That's roughly the paper. So let me just show you what the asset prices show. So we look at levels of interest rate expectations. These are from interest rate swaps and inflation swaps. And we focus on 2-year, 3-year, and 5-year horizons to get at forward rate expectations and forward inflation expectations. So that's sort of the more bread and butter standard stuff that everyone looking at first moments looks at. The more novel part here is to look at the second moments, which is what's going to happen if there is some shocks. And for that, we need uncertainty metrics. So for rates, this is relatively straightforward. We can look at treasury ETFs. That's a more standard way to do these things now. So there are exchange-traded funds, say on 7-year duration bonds of US Treasuries with expiries at 6-month, 1-year, 2-year, and you can back out the implied volatility of interest rates from that. What you don't get directly is the implied volatility of inflation from the markets. But there's a small trick that one can use, which is that there is the real rate, so to speak, which is traded in some form, which is the TIPS exchange-traded funds. So these are the Treasury inflation-protected securities of the US government. And ignoring for the time being anything about specialness of nominal treasuries, etc., essentially these two rates, the nominal rate and the real rates, allow you to sort of back out an inflation, and then you get the simple relationship that what you observe as the nominal ETF volatility is related to the real rate ETF volatility, but you have to make some assumption on the correlation between these two rates. So basically, the nominal return is the real return plus inflation, so you have a volatility equation that's going to relate the left-hand side to the sum of the two. The question is, how do you get at this correlation? It turns out it's relatively stable, it's slightly positive. You can either use a rolling correlation or just an entire sample correlation. The results are not much affected. Okay, so that's just the data part. So what do we find? First, just on the first moments, what you see is that expected inflation rose quite sharply and then fell, nothing new here. And you can see already what I was going to hint at, that even when expected inflation rose, expected interest rates for a while in the right-hand side plot didn't actually rise for a while, for about 8, 9, 10 months. They are basically relatively sticky. Inflation is rising very sharply, but the market says they are not expecting any interest rate hikes from the Fed. More interestingly, if you look at the standard deviation, so now these are the uncertainty measures, sigma pi and sigma I, what you see is that sigma pi rose initially quite a bit and stayed high, whereas sigma I had completely collapsed. Okay, and then eventually you can see from July 2021, both sigma pi and sigma I are rising a little bit more, especially from the vertical line. Sigma I starts rising sharply as well, and that's when Fed effectively reverses from its transitory stance out there. So if you just take this measure that I was talking about, RI VIX, which is the ratio of these two, what you see is that it's relatively low in the early phase and then starts rising quite sharply. And I'm going to interpret this in a model as basically restoration of Fed's credibility. That Fed's credibility was low to the left of the second vertical dotted line, and that Fed had to work pretty hard to raise this credibility. And this ratio sigma I to sigma pi can be thought of as a way of simply getting market's estimate of Fed's credibility. Okay. So to get at this, we build a relatively straightforward model. There's nothing fancy about it. So I'll set it up but not get into the algebra too much. Essentially, it's a version of this IMF model which was in place at the central bank in India. Current inflation depends on expected inflation, the central bank's policy, and an exogenous shock. So I'm going to do away, in interest of parsimony of the framework, with an output gap model through which the central bank's policy is coming back to affect future inflation. Instead, I'm just going to suppose that the interest rate decision today has some corrective effect on inflation going forward. So the current inflation will directly feature in the policy rule through that. Okay, but there could be some exogenous shocks. Importantly, the policy follows a rule, so there'll be Taylor rules of different types, dovish or hawkish, but the parameter of the central bank at a given point of time is unknown to the agents. Okay, so now you can have two types of models here. Either the parameter is stationary and the markets are constantly learning about the parameter. Maybe that's a more reasonable way to go. Instead, what we are going to do in the data is simply to take each snapshot as just telling you what the market's calibration of the parameter is. So we are not going to impose any stationarity requirements on these parameters. And maybe that's reasonable in a world where Fed itself was probably changing its type quite at a high frequency, I think. So agents then update beliefs by observing policy actions. And we have to assume here that there's some background natural rate. That's a whole discussion in itself. I think, as Claudio has written quite extensively about, it's not easy to estimate. So we have to make some reasonable assumptions and check robustness to all of that. So you can solve then this type of a model with forward interest rate according to that equation, and you can back out expected rates and inflation at different horizons. But interestingly, you can also back out standard deviations of rates and inflation at different horizons. The uncertainties arise because of shocks and the Fed policy type. And then you can simply calibrate all of this to this market data, sigma I, sigma pi, etc., that I showed you. So formally, you can think of inflation and nominal rates, pi and I, as deviations from their natural levels, pi star and r star plus pi star. And the key equations are then the state equations for the deviations. So the pi t, which is the inflation, is a function of future inflation or expected inflation. There's some correction action happening through the Fed's current action I, and then there's some shock, which is a composite shock of everything happening to demand and supply. It's very simplified in that sense. The key part is that the interest rate I is set according to the Fed type phi, the parameter phi, that's the policy response coefficient on forward inflation. And then there's some autoregressive structure to the shocks, and you can have some action coming from the persistence of the shocks possibly as well. So essentially then there's some simple learning that happens in the model. And to make it as stripped down as possible, we just assume that there are two types, phi high and phi low, but that even the high type doesn't pursue its Taylor rule with perfect predictability. So basically there's an error epsilon in the action. You can think of it as a policy error. So the type J acts according to the type J's Taylor rule coefficient phi j with probability 1 minus epsilon, and it deviates with this policy error epsilon. Okay. So then it's very, very straightforward. You observe a particular action. It will be along one of the two coefficient types. You know the policy error epsilon that's prevailing out there. So given your earlier priors on the type, you keep updating what the Fed's type is through a simple Bayes rule application here. Okay, so let me not get into why the model is simplified and how it could be richer, etc., etc. So the key construct of the model turns out to be this RI VIX, which is the ratio of the market's expectation of variability of future interest rates relative to future inflation. Okay, so uncertainty at t about forward interest rate S periods ahead relative to uncertainty at time t about forward inflation S periods ahead. It turns out in the model you can analytically describe this ratio, which I'm calling as RI-VIX. As you take the limit of this to sufficiently long periods ahead, you can start deriving some analytical results in terms of how it behaves. And the simple result is that credibility increases relative uncertainty, okay, which is that as Fed's type becomes more in line with, let's say, a standard or a hawkish Taylor rule, interest rates should be more volatile relative to inflation. Okay, that's the basic result. In contrast, if you have shocks that are just driving inflation, for holding constant the Taylor rule coefficient, this ratio should have no variability. Okay, the interest rate to inflation uncertainty should not be affected by these shocks. Okay, so that's the analytical part. So now there are two things I want to show you. First is a very simple calibration. In the baseline calibration, I'm going to choose two coefficients for phi h and phi l to be 1.5 and 0.5 on this forward inflation. Kappa, which is the corrective effect on inflation, is going to be put to 1, and we assume some persistence parameter based on historical data, but we can play around with that, possibly with a bigger cross-section of options, even try and calibrate some of these extra parameters. So what do we find? We find that this is what you observe is the implied belief of the central bank from the market. Okay, which is that in the early phase of the pandemic, and actually even prior to the pandemic, the market calibration of this sigma I to sigma pi, the RI-VIX, would have implied that Fed was actually pretty dovish in its actions. It wasn't as responsive to inflation as per this calibration. And you can see that even if you take the pre-pandemic level as some sort of calibration issue, at a minimum, it's declining as we are getting further into the pandemic. And then you can see that around Jan of 2022, there's a sharp reversal, which is that the interest rate volatility actually picks up relative to the inflation volatility, implying that the Fed's credibility as per this model is ratcheting then back up to close to P equal to 1. And interestingly, as when our sample ends, because these options data are not yet updated in our option metrics data set, actually it ends by middle of 2023, August of 2023, at actually close to a P of 1. That Fed had basically completely restored its credibility to having a Taylor rule response coefficient of 1.5 as per this calibration. The nice thing about writing down a structure of the model is that you can then ask some questions, which is, as you are observing these uncertainties of sigma I and sigma pi, can you decompose that into how it's changing because of changes in the credibility? How is it changing because of changes in the shock volatility, et cetera, et cetera? And without getting into the specifics of how we exactly do this in the model, what you observe is the following, which is that if you look at sigma I and sigma pi by themselves, which is look at interest rate uncertainty and the inflation uncertainty by itself, what you observe is that the credibility was a big contributor to inflation volatility itself, as you see on the right-hand side. And then as credibility is restored to 1, the component of volatility of pi that comes from credibility goes down. In contrast, because credibility was initially low, the interest rates are driven entirely by the shocks in the first period. Okay? Conversely, now, if you look at RI-VIX, which is the ratio of these two, this says that the ratio became very low initially, and that was all because of a lack of credibility. Okay? That interest rates were not volatile simply because Fed was seen to have a Taylor rule coefficient, which was basically very, very low over this period. And then as I showed you, P goes to 1 in the calibration based on this data, and that implies that the ratio is no longer getting a dampening because of this. And then once that happens, all that is left in the inflation is coming from shocks. It's not coming through central banks' lack of responsiveness to the inflation. Why does that matter? I just want to pinpoint that in the equation. That's because if the central bank is not taking a corrective action, future inflation will be high because the phi IT term that's correcting inflation is not going to be bringing inflation down. Okay, one last point. You might say, did I really need a model to do any of this? It helps with some structure of this type. But it turns out there's a very simple reduced form way of thinking about this RI VIX and whether it can be a relevant metric for credibility the way I was describing it for the Central Bank of India. So what we do is the following. Now we are going to take a longer stretch of data from 1980 to 2023. And simply estimate Taylor rules. So we are estimating the Fed funds rate on as the Y variable, and we are looking for its coefficient on the core CPI. And I'm just going to interact this core CPI with this RI VIX, okay, which is this ratio of interest rates to uncertainty backed out from the market. There is one caveat, which is that ETF options on treasuries and tips are not available prior to 2010. So for that, we have to do an in-sample calibration from 2010 to 2023 of the volatility itself using commodity implied vols and the level of the CPI. And we are extrapolating that function back in time to get a metric of sigma I, which is the interest rate volatility out there. Okay, so the result is the following, which is that RI VIX firstly has declined over time. And the way we interpreted this is that maybe during the Paul Walker era, that became very high. Central bank credibility got restored to a very high level, but that perhaps steadily since late 90s, the Fed credibility as per this metric has actually been quite low. It's been relatively dovish as per this metric compared to the Paul Walker era. And what you see that is then in this coefficient on Taylor rules, which is that you see that on average the core CPI, unconditional Taylor rule coefficient is about 1.4, but it does vary over time, and that variation over time is captured through this interaction with RI VIX, which remains a very robust interaction coefficient on the core CPI. So it says that if you just use this sigma I to sigma pi as a measure of central bank credibility, if it's high, it's going to tell you that the Fed response coefficient is high. Okay, and that's what you see. Two quick things. One, we don't find as robust a variation of credibility on the output gap, but we need to do a little bit more work on this, do regime switching, etc., which we haven't yet done. More importantly, there's a notion in Taylor rule coefficient estimates that sometimes they vary over time because there is gradualism, and there is good reasons to have gradualism because Fed is not certain about the model or the reaction of the market. Usually that gradualism is estimated through a lag coefficient on the Fed funds rate, which is in columns 4 to 6 in the last row. And what you observe is that gradualism is entirely unaffected by the credibility parameter that we have. Okay, so that core CPI into RI VIX, that effect is almost unrelated to the gradualism of the Fed in responding to this inflation. Okay, so let me conclude. The idea was to just give a positive metric of how to measure central bank credibility with the simple idea of RI VIX, sigma I to sigma pi. And it says that when credibility is low, inflation will have high uncertainty, but rate uncertainty will be quite low. That's it. Thank you.
And we'll have Jurica Zrnc giving us the comments. Thank you.
Hello, thank you for the opportunity to comment on this paper. So, as a last-minute discussant, a surprise, then I will basically be a bit short, and I'm filling instead of Luke, but I also kind of benefited from seeing his slides, so his discussion slides. So if you hear some insightful comments about the paper, they might actually belong to Luke, not to me. Yeah? And so in general, so these are my own views and not the views of the central bank. So the main question in the paper is how did the uncertainty about the monetary policy and inflation evolve in the United States, and what were its main drivers? And maybe more to the point and more controversially, did the monetary policy lose its credibility during the inflation surge in the US? And a very nice feature about the paper is that they use the market-based data on the conditional first and second moments of inflation, future expected inflation rates and interest rates. And the key observation is that this relative uncertainty, so the variance of interest rates relative to the variance of expected inflation rates, was low in 2020 and 2021, which they then through the model interpret as low credibility of the Fed, but then rose sharply in 2022 and 23. Yeah. So now I'll summarize a bit of the model, and then I'll give the main results, and then I'll give my comments. Yeah. So the model can be viewed as a stripped-down version of the standard New Keynesian model. There's no output gap. There's just a simple exogenous process for shocks to inflation, and there's no production side of the economy, so you cannot really disentangle demand and supply shocks in the model. And what's then put additionally in this model is a central bank type. So essentially, the central bank can be hawkish or dovish, and the market participants are not sure what's the type of the central bank. They learn through actions of the central bank about the type of the central bank. So if the reaction of the central bank is especially large to inflation, meaning that for example, if there's a large increase in inflation and the central bank increases its interest rates by a lot, then there's a larger probability that the Fed would be of a high type, would be hawkish. Okay, and so they use this model to disentangle two key mechanisms, whether essentially this ratio of uncertainties is driven by shocks to the economy, so shocks to the persistence of so that this would be kind of team transitory narrative. Also shocks to the uncertainty of the inflation in the future, or beliefs about the central bank type. And so they use this model to disentangle these two main narratives. And what do they find? Well, they find, in line with the movements of this relative uncertainty, that essentially most of the movements in the relative uncertainty in the early period of the inflation surge can be explained by the credibility of the central bank, while later then the credibility of the central bank rose. And this is also very important then, as Viral showed, for inflation rate dynamics during the period. Okay, and so maybe the first comment here would be that one can also imagine that this relative uncertainty, so this low relative uncertainty, could also signify a high credibility bank. So, for example, a central bank, a highly credible central bank, might each movement in interest rates of a highly credible central bank will have larger effects on future inflation. So we might think then that essentially a low credibility bank will have a higher, would need to increase interest rates by more to decrease inflation. And then if you look at the cross-section of central banks in the world, you might actually observe the opposite correlation between credibility and this relative uncertainty. Okay, and then I have a brief comment about the simple Taylor rule, which you also recognize in the paper. I mean, the Taylor rule is very simple. It just has inflation inside. We know this is actually not true, obviously, for the Fed. And then I'm wondering how much of heavy lifting is this doing for your results, right? And this is something you'll for sure do in the paper. But then I'm wondering whether these, for example, dovishness of the policy can be actually interpreted as a small reaction to an inflation shock might be interpreted as dovishness, but that could actually be just looking through. So there could be just a supply shock that's happening in the economy, and so the central bank just doesn't react to it. And does your model then disinterpret as dovishness? That's maybe my question. And then I'm also wondering, maybe there's also data about analysts' expectations. We have something like this in the euro area, the survey of monetary analysts, where you can actually observe also long expectations about long-run growth. Then you might have a measure of the output gap in the model for each analyst. So that might be useful to pin down this kind of supply-side mechanisms as well. And then, in the end, if we take your results at face value, so that the Fed really lost its credibility, is it because the Fed was actually more dovish? Or is it because there was an issues with the communication? So was it just a communication issue, so that the beliefs of the markets drifted away from the Fed's true type, or did really the Fed's type change? That would be a nice thing to know, to have a kind of, to hear your stance about it. And in the end, at the ECB, we also have, not we, they, at the ECB there's also a nice research showing that the simple information treatments, so saying to people what is the goal of the central bank, or even talking to them a bit more about the central bank goals, increases the probability that they expect that the central bank will achieve price stability in the next 3 years. So there's a lot to be expected from communications efforts in the future, and it will be nice for us to then to know whether at least part of your results could be explained by communication issues. Yeah? Thank you very much.
Thank you very much, Jurica. We started late, so I suggest we take a couple of questions from the audience, so we have some participation. I see one hand there, and then we'll give a chance to the authors to respond briefly to all the comments. Yes.
Thank you, Jan. I'm Steve Cicchetti from Brandeis University and the ESRB. I have a question for Michael. I very much appreciate the idea of thinking about the central bank's liabilities and its impact on commercial bank assets, but commercial bank assets have to be balanced by commercial bank liabilities. My casual recollection of work by Viral and colleagues is that large increases in central bank bank reserves, commercial bank reserves, resulted in large increases in uninsured deposits, which then did something. Now, I think in the equilibrium of your model, my guess is that you had inflation flat, so I'm wondering whether or not your view is that velocity has to fall precipitously. So is velocity then somehow, which is a residual, taking up this? Why is it that inflation's not falling? The second thing I have is a question that's related to some facts. One of the intentions of the regulatory reforms in the aftermath of the global financial crisis was to eliminate at least as much as possible, wholesale funding for banks, and that included interbank lending. It's hard for me to get quickly information for other countries, but I can tell you for the US, there's basically none. There's basically zero interbank lending going on for the US. There is a modest Fed funds market, but the borrowers are foreign bank offices and the lenders are home loan banks. And the reason that the borrowers are foreign bank offices is because they're exempt from deposit insurance premia. So this is I think we're in a world right now where there's virtually no interbank lending for regulatory reasons. And I'm just wondering how it is that squares with your results. Thank you again.
Thanks, Stephen. While we have one, yep, right here. Yes, yeah. Right here in the middle.
Bank of America. On the first paper, I mean, you cannot have QE without QT. And QE is easy. You throw money. QT is difficult. And this is an asymmetry that creates problems. So you can argue when you do QE, you should take into account the side effects from QT. But then it is too tempting to ignore it. Is one of the policy implications of your paper that actually you should proceed without being concerned about possible side effects from QT because you can use counter-cyclical reserve management to address them? So QE and QT should proceed based on what you want to do in terms of your monetary policy stance because you can use your reserves to address any QT side effects. And on the second paper, I mean, it is clear that to gain central bank credibility, you need to have higher interest rates than otherwise. However, you can also argue that once you have central bank credibility, you have lower interest rates than otherwise. I'm not sure where I can see the second effect in your results.
Okay, please, we have one right here up front, right here. Good.
Thank you. Well, Michael, you know, first of all, that I'm very sympathetic to the idea of having models in which banks actually create money and this distinction between saving and financing. Now, I have some questions about your model. I mean, you went through it relatively quickly and there is a lot to absorb, but first of all, the mapping of your model with the real world in the United States, I didn't see the deposit facility rate, the rate on the deposit facility of the central bank. You were using the reverse repo rate, which is below, of course, it was introduced in order to set a floor to the overnight rate. And that's below the interbank market rate. But it's not, but you don't have the deposit facility rate in your model. So what kind of model of the operational framework do you have? That's the first question. Related to that, is in your model the interbank rate, which we would say like the operating target, a kind of sufficient statistic for the impact of monetary policy on the economy? Or maybe is it a sufficient statistic conditional on the bond rate? That is what I didn't understand. So, and if it is, in either of those two senses, if the central banks, as they're doing now, they're trying to control some kind of overnight rate or short-term market rate, which in your model would be, call it your interbank rate, although, as Steve was saying, there is not much of an interbank market because you have excess reserves in the system. If they do that, plus they have a look at the bond yield, would they do anything different from what they're doing now? And is therefore your model just a model that tries to explain how the interbank rate is set? And finally, although you do say that in the model, again, mapping between the model and reality and what you have there, there is no run on the banking system as a whole. Ironically, an implication of introducing the reverse repo facility, which allows basically non-banks to put money with the central bank, introduces the possibility of a run on the banking system as a whole. And so I was just trying to understand, again, the mapping between what you were showing up there and therefore your model and reality.
Thank you. So we have one more last question from over there, and then we'll give a chance.
This is for equal opportunity, is for Viral. So I think your measure correctly is a correct proxy for the sensitivity of the central bank policy to short-term inflation. I don't think it's fair to characterize this as credibility. I would rather look at some ratio of long-term versus short-term inflation expectation. And if you look at the definition of the mandate of the Fed, they don't say they are going to match inflation below 2% every year. And so, and this is echoes the Discussant and some other comments, you could have a situation where the inflation rate spikes incredibly in the short term, and people look at that, but they think the Fed is going to operate somehow, maybe not through the interest rate, maybe just through forward guidance or some miracle, and bring the interest rate back to 2% over the long run. And so that would be, I think, a more direct measure of credibility. I think your measure is a perfect measure of the short-term Taylor rule sensitivity, but I would not give it the credibility, name. Thank you.
Okay, thank you. Well, why don't we give each author 5 minutes to quickly respond, and then there will be the coffee and photo op.
Please. Okay, yeah. A lot of the comments is sort of, in a policy audience, it's interesting. It's typically the opposite of an academic audience. I usually get accused of this paper being too complicated and trying to capture too much of the real world in one model. But a lot of the comments here went in the opposite direction, saying you still don't have enough. And to some extent, that's fair, because it is still a model and I have to keep it simple. Now let me start with the Discussant, and I'm going to cherry pick here because there was quite a bit there, and I thank you for a generally positive discussion. The notion of money creating inflation, and so if you increase reserves, there's no problem in our model. And what's the connection between those two notions? Of course, and you understand that, it's retail money that matters for inflation. And if you increase wholesale money, if you increase reserves, that has no direct effect on inflation. The only effect comes through what the banks do with that additional interbank liquidity in order to stimulate or not stimulate the economy. So the whole notion that a money multiplier does not really exist, it's a number that you can compute, but it is not a transmission mechanism, is here. And I think we understand each other. You asked about higher government debt. It's actually something that I had to skip over because there wasn't enough time, but in the paper there are additional steady-state simulations for what happens when you do QE in order to absorb additional government debt, because in the simulation that I showed you, the government debt stock was constant. So I refer you to the paper there. You asked about what would happen with fiscal shocks, what would that do to inflation. That's a broader thing. Essentially all shocks that we are familiar with from new Keynesian models that have nothing to do with the interbank market, no asymmetric shocks across the banking sector, run shocks, etc., their effects are pretty much the same, because it's the asymmetries that matter for the interbank market to have an effect. So if you have fiscal shocks, the model is not going to tell you anything that you don't already know from other models. Larger balance sheets have positive effects on in the model. Yes, but there's a limit. These positive effects are going to go to zero if you make the balance sheet larger and larger, because the benefits of additional liquidity go towards zero. So it's not like you have a free lunch here. So I cherry-picked, and if I missed anything, then let's discuss this over coffee. Steve Cicchetti, reserves going up leads to increases in uninsured deposits, and what's that going to do to velocity? Velocity it always depends on what velocity, what quantity of money do you include here. And the velocity that I think matters is retail money balances relative to transactions, whereas what an increase in reserves tends to do, it doesn't affect retail money balances very much. It leads to an increase in wholesale money balances, which don't necessarily... In the model, we have retail and wholesale money balances on the bank balance sheet side by side, and it's only the retail money balances that lead to an increase in spending and therefore activity. Inflation, why is it not falling? I'm not sure whether you refer to the steady state simulation or the dynamic one. In steady state, of course, the central bank can keep inflation with a policy rule constant. Inflation is basically constant there by construction. World with no interbank lending. In the US, it is true. I mean, in a way, you should think of our banks as the overall financial system, not necessarily only as commercial banks, because there are other participants in the interbank market, in the market for wholesale balances in the United States that are not only commercial banks. This is also true in the UK. So the model is a bit sort of stylized in that sense. But I would like to talk to you more about that over coffee, if possible. Claudio, yes, there is no deposit facility rate in the model. We only have the ONRRP. Our model is very stylized in that sense. I'll have to think more about this question and whether we can address this within this framework. Whether the interbank rate is a sufficient statistic. The interbank rate, well, in the model what we have is an interest rate on reserves, wholesale deposit rates, interbank rates, wholesale lending rates, etc., etc. As we saw when we talked about the Wissing-Jurgensen ISO market rate curve, the interbank rate is driven by the interplay of both policy tools of the central bank. So in that sense, I guess it is a sufficient statistic for what both tools together do, right? Quantifying that in practice will be quite difficult because it depends on the transmission channel whether the rate tool or the balance sheet tool has predominant effect, and that depends on things like the reserve curve for demands and stuff like that. That would be in practice quite difficult to sort out. And I'm being told I have to cut here, so I'll cut here.
Thank you, thank you. Okay, Viral, if you can give us a few comments back.
Is this on? Or okay, yeah, thank you for all the comments and discussion at the last minute. Maybe I'll sort of do them just interleaved because they're all the questions are about the same point at some level. So there's only sort of two equations in the model really. One is on the inflation today. So that's a function of expected inflation tomorrow. But then there's a corrective effect that comes in from the policy today. But now if you take that forward, the inflation in future is also a function of the expectation of the policy function. So there is implicitly in the model a corrective function coming from central bank action at each point. And I didn't stress this, but the model is calibrated both to the uncertainty or the options data as well as the levels data. So I just quickly mentioned in the passing that we are also using the levels of expected inflation and interest rates. And that sort of then dovetails a little bit into Giovanni's question, which is a trickier one because it's sort of, you have in mind a model in which the central bank, as someone mentioned, is looking through in the short run, but in the long run, it's going to have a very sharp response and anchor things back if required. One, we don't have that, so the central bank is only sort of a per period adjusting model here. And then what that would require is that somehow you allow the P's to be very different in different future periods, and then you simultaneously calibrate the entire term structure of uncertainties to that. Now, in principle, it can be done. I think a better way would be one in which perhaps you assume that the central bank credibility parameter is stationary rather than period by period the way we are calibrating it, so that you are disciplining across the entire term structure and over time something in the process. But I think I broadly agree with your point, and I think this goes back to the discussant's points on looking through, which is that, so again, going back to the first equation, there's this corrective dampening effect of interest rate on inflation, but maybe in a time of supply shocks, maybe that's weaker, which we are not yet allowing for. We have just started touching a little bit in that direction when we did our Taylor rule estimation over the longer period. We also had the output gap and the interaction of output gap with RI VIX. I think a better way to do would be to actually build the output gap straight into the inflation equation, allow some variability of demand and supply shocks there, and yet see if the calibration implies a lower credibility of the Fed or not. So I think that is exactly the next step we need to do, and we have just done the bare minimum right now. Thank you.
Thank you very much. Well, let's thank the authors and the discussants. And we're back in the hands of Tomislav.